The Personal Consumption Expenditures Price Index for July will be released at 8:30 a.m. Eastern Time. Joining us now with more on inflation and the Fed's next move, let's bring in Bethan Ann Bovino. She's chief economist at U.S. Bank. It's great to see you.
Great to be here.
Thanks for coming in. The markets seem to be acting as if inflation is last year's story in some respects, and they want to kind of file it away as the mission accomplished the data point here. Is it fair to do that? Is there anything in this number today that you think could upset the current stance?
Well, I think what the factor is that the Fed has also seemed to indicate that they're confident with where inflation is going. It's stabilizing. That's positive. That said, let's keep an eye on what happens with core prices, excluding food and fuel, but also the supercore, excluding housing. Supercore, excluding housing, is still over twice what the Fed would like it to be, and seeing something unsettling there would certainly put the Fed on hold.
You think it would actually be enough to put it on hold? Because it feels as if we now are at a point where they're willing to look past a month-to-month variation in versus their expectations, right? I mean, their consensus view on where PCE and core PCE would be right now, at this point, it's kind of where the data are, right? So in other words, if they're saying we have clearance to go for a cut in September, I wonder just, exactly how high the bar is for changing that.
It's pretty high.
Yeah.
Well, and also keep in mind, CPI and PPI came out, which is kind of gives you a little hint of what we can expect for today's numbers. Mm-hmm. They came actually a bit calmer than what markets expected. So that would suggest that the PCE readings and core PCE readings are also going to not disappoint. That said, the Fed has been pushing, basically saying, we're done, we're ready, we're good to go. If they move away from that, they're going to need something extreme in order to make that call.
And I mean, we are also going to get personal income and spending. So there's been this extreme sensitivity to any signs that the consumer is tiring. You see these pockets of weakness. We were talking about Dollar General just a little while ago. And then, the labor market, while it seems like it's moderating and it's softening in a benign way, there's those who are saying this is not good. Hiring is really falling away. So where's the economy on the consumer and labor side right now?
Well, that's a very good point. And one of the things that I've been saying is that this week, initial jobless claims and also the personal income report were sort of the opening acts, but the headliner is the jobs report next week. We're expecting, when we saw the last month's numbers, we thought markets had overreacted for several reasons. One, July is usually rather soft because it's a summer season. People aren't able to get the people in to even sign the contract. Also, that jump in the unemployment rate, I saw that as a good thing. It was a rebalancing. You saw people coming back to the workforce. If that was held constant, the unemployment rate would have been around 4%. That said, I think what markets and what the Fed needs to see is a rebound in those readings, because they do indicate that they're a bit nervous about the jobs numbers. We're expecting about 175,000. Could we see something a little higher? Sure, that would be okay. But if we saw something much lower, say under 100,000, that would really spark the Fed's interest and probably make them be a little bit more aggressive than maybe what markets and we are thinking right now.
What do you think markets suggest about the Fed's aggressiveness and their need to be more aggressive in terms of cuts? I ask because Treasuries are poised for their longest monthly winning streak in 3 years. Does that alter the market dynamic, if at all, for the Fed to cut 50 basis points versus 25 basis points if the market is kind of doing that job for them?
Well, that probably helps the Fed. But again, the Fed is focused on the economy, and their target is what matters to them the most. Right now, we're expecting 25, probably most likely 25 basis points from the Fed. Of course, only they know what will happen. But given that, as I said, the inflation reading seems to be coming into what they want to see, which is a calmer or more sustainable inflation reading. They seem to be more confident about that. What happens with the job market is going to be the final, the final blow, I guess you could say, for when they move. And if they see calm numbers or numbers that are around maybe 175, maybe a little higher, that would give them reason to move. And we think about 25 basis points. Now, if you saw a much lower number, regardless of what market's doing, then they might need to be more aggressive.